Every evening, the news anchors speak with a rhythmic urgency. A record-breaking close, 70 stocks hitting all-time highs, an unprecedented surge in IPOs. We are conditioned to watch these flickering numbers as if they were the heartbeat of the nation. When the ticker glows green, we are told the economy is thriving. When it turns red, a cold shiver runs through the financial spine of the country. For nearly 40 years, the American stock market has been on a relentless upward trajectory. It is a seductive narrative. If the market rises, prosperity follows. If it crashes, the wealth and stability of the middle class vanish into thin air. We are led to believe that a soaring Dow Jones is a tide that lifts all boats. Since the last election cycle alone, the market's valuation has swelled by nearly $3 trillion. But if we step outside the glow of the trading floor and look at the actual exchange of goods and services, the real economy, a different story emerges. Wages for the average worker have remained virtually stagnant for decades. The median net income for the American family has yet to truly recover from the scars of the Great Recession. This raises a fundamental, almost haunting question. If the people aren't getting richer, what exactly is the stock market measuring? Part 1. The Lemonade Empire. To understand the mechanics of the market, we must look past the complex algorithms and high-frequency trading. Imagine a simple enterprise, a lemonade stand.
Let's call the founder Jill. Her product is a hit, and her ambition is even greater. She wants to expand, but she faces a classic hurdle: capital. The bank considers her venture too risky for a loan, and wealthy private investors aren't biting.
Jill turns to her final option. She decides to take her company public, offering a piece of her dream to anyone willing to buy in. This is the initial public offering, IPO. Investors pay a set price, perhaps a single dollar, to own a share of Jill's business. With this influx of cash, Jill can build 10 more stands, hire staff, and develop new recipes. As the business grows, so do the profits. Jill can then choose to share these profits with her investors in the form of dividends. While not mandatory, dividends keep the investors excited and loyal. Then there is Sam. Sam missed the initial offering, but he sees Jill's success and wants in. He offers to buy a share from an original investor for $2, double what they paid. Sam isn't just buying a piece of paper. He is buying a belief in Jill's future.
This is the essence of the stock market. A global marketplace where people buy and sell tiny fragments of companies based on their collective faith in what those companies will be worth tomorrow.
Part 2. The Engines of Wall Street. What Jill and Sam are doing happens millions of times per second across the globe. While stock exchanges exist in almost every major capital, the New York Stock Exchange, NYSE, remains the grand stage. Its origins trace back to 1792, when 24 brokers gathered under a buttonwood tree on Wall Street to formalize their trades. Today, it is the home of industrial titans like IBM and GE. Then there is the NASDAQ, the NYSE's younger, tech-driven sibling. Born in 1971, it exists not in a physical building, but in the digital ether. This is where the giants of the new age, Apple, Facebook, Alphabet, reside. To track the health of these massive ecosystems, we use indices. The S&P 500, a broad pulse check that tracks 500 of the largest companies in the U.S. The Dow Jones Industrial Average, a more exclusive club monitoring just 30 companies deemed the pillars of the economy. Every nation has its own version. The DAX in Germany, the FTSE 100 in London, the Nikkei in Japan.
In the 20th century, companies were often the personal fiefdoms of great men. Carnegie, Vanderbilt, Rockefeller. These titans held absolute control.
But as the century progressed, companies like General Motors realized that by inviting the public to own shares, they could unlock levels of growth previously unimaginable. Part 3. The two faces of the market. In theory, the stock market is a powerful engine for good. It creates a feedback loop of accountability. If a CEO makes a disastrous decision, investors sell their shares, the price drops, and the leadership is forced to correct course. Conversely, the lure of future profit encourages people to fund radical, world-changing ideas. Mid-century America saw this engine at its peak. The public corporation was viewed as a vehicle for shared prosperity. It wasn't just for the elite. It was for the common citizen. This era produced millions of secure, well-paying jobs and innovative products sold to every corner of the earth.
During this golden age, executives viewed themselves as trustees. Their responsibility wasn't just to the shareholders, but to their employees, their suppliers, and the communities where they operated. They built the American middle class.
Among those who mastered this system was Warren Buffett, the Oracle of Omaha. Buffett's philosophy is value investing, the painstaking analysis of a company's soul, its balance sheet, and its long-term viability.
For the average person, Buffett offers a simple, humble piece of advice. Buy a low-cost S&P 500 index fund. By doing so, you aren't gambling on one horse. You are betting on the entire race course.
Part 4. The Keynesian Beauty Contest. However, the market isn't always driven by cold, hard math. The legendary economist John Maynard Keynes once compared the stock market to a newspaper beauty contest of his era.
In the contest, readers had to pick the 6 most beautiful faces from 100 photos. The prize didn't go to the person who picked the faces they liked best, but to the person whose choices most closely matched the average preference of all other contestants.
It is not a case of choosing those faces which, to the best of one's judgment, are really the prettiest. We have reached the third degree where we devote our intelligences to anticipating what average opinion expects the average opinion to be.
In the stock market, the price often reflects not the actual value of a company, but the most popular story people are telling about it. Sometimes these stories are rooted in reality, like when Chipotle's stock plummeted following health scares, or Volkswagen's dip after an emissions scandal. But sometimes the story takes on a life of its own. In the late 1990s, the story was the internet. Investors believed that dot-com companies would rewrite the rules of gravity. Profit didn't matter. Eyeballs and clicks did.
It was a beautiful story, but it became a bubble. When it burst, it didn't just hurt the speculators, it wiped out 300,000 tech jobs and nearly derailed the global economy.
Part 5. The Shift from Stewardship to Greed. By the 1970s, a sense of unease began to permeate the American economy. Energy crises and rising prices led people to look for a scapegoat. Enter Milton Friedman. Friedman, a charismatic and influential economist, argued that the social responsibility of business is to increase its profits. He believed the trustee model was a mistake. To him, the corporation belonged to the shareholders, and the shareholders alone.
This philosophy was immortalized by the character Gordon Gekko in the film Wall Street. Greed, for lack of a better word, is good.
Corporations took this to heart.
They began tying executive compensation to stock price. If 80% of a CEO's pay depends on the share price rising over the next 12 months, that CEO will do whatever it takes to make that number go up, even if it means cannibalizing the company's future.
Instead of investing in research, better wages, or new factories, companies began a practice called stock buybacks. They used their profits to buy their own shares back from the market, artificially reducing supply and driving up the price.
Between 2007 and 2016, S&P 500 companies spent over half of their earnings on buybacks. Another 39% went to dividends. This leaves almost nothing for long-term growth. It is the difference between a farmer who plants seeds for the next decade and one who eats his seed corn to survive the winter.
Part 6. The Human Cost. The real-world consequences of this short-termism are devastating. Take the case of Wausau Paper. In 2012, they were investing in a long-term plan to modernize their mills.
But a hedge fund bought a stake in the company and demanded immediate returns. They didn't care about the 100-year history of the company. They wanted the stock price to jump now.
The result? The Brokaw mill was closed. 450 people lost their livelihoods. One worker recalled burying his father the same day he was told he no longer had a job. The town's heart was ripped out to satisfy a quarterly report.
This is the dark side of the modern market. Firing workers and suppressing wages might be terrible for the economy, but in the short term, it makes the company's numbers look better, which the market rewards.
Reclaiming the market. The gap has become a canyon. In 1973, a CEO earned about 22 times what an average worker made. By 2016, that ratio soared to 271 to 1. As the stock market reaches historic heights, the percentage of Americans who actually own stock is at a 20-year low. The prosperity is no longer shared. It is concentrated. But it doesn't have to be this way. The stock market is a tool, a remarkably efficient one. It allows us to vote with our capital on which ideas deserve to shape the future. Most of us are not short-term gamblers. We are parents, neighbors, and citizens who care about the world our grandchildren will inherit.
We want companies to succeed by doing something useful for humanity, not by destroying the social fabric for a temporary bump in share price. The market is ours, and it is time we remembered that its true value isn't measured in points on a screen, but in the lives it helps build.